Hi, and welcome to Your Future, Your Finances. I, again, am your host, Brian Kuhn. Today we're talking with Michael Paciotti of Integrated Capital Management regarding investing and wealth management. Welcome back.
Glad to be here.
So for anyone who missed the first segment, tell us a little bit about how you create investment portfolios and how you work with financial advisors and their clients.
So our firm, Integrated Capital Management, is, as we discussed, traditional investors. We're value-based investors. We partner with financial advisors as kind of their personal investment department. So, what does that really mean? If you cleared out a section of your office, right, and plopped an investment department in there, then all of the things that you could possibly imagine, an internal investment department doing for either a large plan sponsor or doing for yourself, that's really the role that we fill, and what we refer to that as is the power of the personal investment department.
Mm-hmm. And when you're explaining this to clients and advisors, you talk about time frames for investing. There's an academic time frame, and then there's what's called a personal time frame, and those are very different when you're creating your portfolio. So talk a little bit about that.
Sure. So we're starting to hear more and more about this these days as these algorithmic trading programs, the quote-unquote robo-advisors, start to become more and more popular. In essence, what it is these programs will take historical data, 100 years of data on the S&P 500, and say that the return on the market was 10% over 100 years. So they'll use that as basically their mark, their estimate for what the future will hold. But the problem with that is how many investors that really have a 100-year time horizon? It's probably a handful, right? Some endowments and foundations, perpetual entities that have those really, really long-term time horizons. And if you're a long-term investor of a 10 or a 15-year time horizon, those results can vary considerably from the historical average. More than 40% of the rolling 10-year periods over the last 100 years underperform their historical average by 2% or more over that 100-year time period. So I would ask you as a planner, how meaningful is that, right? To miss your mark by 200 basis points per year for a decade, that's a pretty big number.
All right, so a lot of data in that, so let me make sure we're on the same page. So over 100 years, it averages 10% per year if you look back the whole time, but you said 40% of the time any 10-year group within it was 2%?
Can miss by 2% or more.
On an annual basis.
On an annual basis,
yeah. The whole total. That's a big difference.
Big number.
Yeah. So short-term investing versus long-term investing, what's the differences in what you do?
So sure. So I'm sure I'm not the first person to ever offer this, but the first thing an investor should do, or the best favor that an investor could do for themselves, is to have a true long-term time horizon. So what does this mean, right? If you're retiring in 20 years, but you evaluate performance daily or quarterly or annually, and you make changes based on that, do you really have a long-term time horizon, right? We would argue no, you don't, right? Your time horizon is really the length of time that an investment is given to work, right? So, Warren Buffett would tell you that his favorite holding period is forever. Well, we don't think it has to be quite that long, but 5 to 7 years should be a minimum. What this does is it really puts odds in the favor of in the investor's favor to ultimately be successful. And when you have long periods, valuations become a pretty remarkable friend for investors.
Now, there's a term in the industry called a bubble, so like 2008, and sometimes these bubbles happen. How do you actually define a bubble so you can keep a lookout for them?
So in very simple terms, a bubble is an outlier, right? So to use a baseball analogy, a 300 hitter in the prime of their career that goes a month without getting a hit, well, that in baseball terms, that would be a bubble. Are they never going to get a hit again? No, that's not likely. They're probably going to get hot at some point. So in investing terms, a bubble is basically an inflated valuation, right? The average PE of the S&P 500 might be 15 times earnings, but the normal ebb and flow might range between 10 and 20. Well, if it exceeds 20, now you start thinking about being overvalued, or the term bubble starts to pop up.
Okay, now you used a term there, PE ratio. So let's explain that. What's that?
So price to earnings ratio is what we refer to as a PE ratio.
Mm-hmm. So that's whatever it's trading at, stock or a bond, divided into how much money the company made.
Divided by its earnings per share. That's right.
Okay.
Yep.
With the markets right now, what do you see? What do you like, don't like?
So, it's difficult to really pick up a newspaper or turn on the television these days without hearing something about the dollar or commodities or China or the emerging world, and there's a lot of fear and angst there. And what we really think is that investors are focused on the hole in the donut rather than the donut themselves. So what you're not hearing a lot about these days is the U.S. equity market, and something we refer to as the nasty little secret of U.S. equities is that earnings on the S&P 500 peaked 18 months ago at $105 per share and are barely scratching out $88 per share now. That's a pretty meaningful drop. So along the way, you had that PE ratio, that valuation level 18 months ago at 17 times earnings. And now you look at it, and it's 22 times earnings, right? So you're now starting to stretch and press up those lofty valuation levels. By the same sense, some of the other assets that we mentioned that are scaring folks these days, commodities, emerging markets, are trading at really historic levels of inexpensive valuations. So those are some of the assets that we think are pretty remarkable opportunities for investors.
Mm-hmm. Okay, great. And not any investment recommendations to a specific viewer, but speak to a financial advisor and talk about it. Anything else you'd like to share? Otherwise, give us a website if somebody can look you up.
Sure. Our website is www.icm-invest.com.
Okay, great. All right, we're talking with Mike Paciotti of Integrated Capital Management regarding the markets. Hopefully got a couple ideas or things to think about there. Thanks for watching. Again, this is Brian Kuhn. You're watching Your Future, Your Finances.